All right, good Thursday afternoon, traders, investors, Finom Group members. Welcome back to Finom Group's weekly State of the Market. I am your host, Seth Golden. Let's take a quick look at what the markets have to offer here at 1:30 on a Thursday afternoon and after two down days in a row. Well, we got the Dow under some pretty good pressure here. S&P's pretty flat. Nasdaq has a nice bid. Small cap Russell. IWM has a decent bid as well, in fact, leading the way. See if we can hold on to these gains here, or are we going to join the Dow in the red? We came into this week pretty hot. Monday, again, new all-time highs in the S&P 500. The new all-time high is now 47.18. And of course, everybody had 4,700 as their price target for the year, and nobody needs a second chance, right? We all had 40. I'm being facetious, obviously. But thematically, yeah, we still hear market participants suggest that the market doesn't give them a second chance. It doesn't pull back. We had a really nice pullback in September, of course, but I think people forget that given just how hot this market has been since the first week of October, 5 weeks in a row. We ran a streak of days. The S&P 500 was up 18 out of 20 days. What does that mean going forward? Well, we'll find out. But indeed, market participants are getting a chance right now. They're getting a second chance, an opportunity to buy the dip here. Market down 2 days in a row, and S&P 500 on an intraday basis from the all-time high of 47.18 has pulled back about 2%. Same, a little bit more actually, about 2.5% for the Nasdaq from its recent all-time high. Nasdaq had a winning streak of 11 days in a row before the recent weakness in the market. Why the weakness? We got overheated, folks. Recall this from last week, right? The 5-day RSI was 89. In the past, we get up into this 90 level on the 5-day RSI, we had some turbulence. It only served as a means to work off some of those overheated conditions and before the market marched ever higher into November, where we've got these overheated conditions once again. This chart was as of November 3rd. Fast forward to Friday's close, and look at where we are on the RSI, 93. We got above 96 on the 5-day RSI as of Monday's close. And with the S&P 500 traveling as high as 47.18. The other thing to denote here about what we see in the chart is I put the 50-day moving average and 200-day moving average in. And you can see whenever we get to about close to 3 standard deviations above the 50-day moving average, we have some kind of price consolidation. Price consolidation, price consolidation. Lo and behold, we got to almost 3 standard deviations above the 50-day moving average once again here on Monday. And we got 2 down days in a row. We got a little rebound going on here Thursday, but there's still time on the clock. We might give it up, or we might see the dip buyers come back in. Point being is, just like last time, where we saw the 5-day RSI get this hot, and after yet another strong successive streak of wins, positive returns, 1, 2, 3, 4, 5, 6, 7 days higher in a row, little relief, and then another 2 days higher in a row, so that wasn't much relief. But these streaks manifest overheated, overextended conditions that beg of some kind of relief. And I think that's all we're getting here right now. This pullback from all-time highs, nothing but relieving these overbought, overheated conditions. So far, year to date, we've got 65 new all-time highs. The only year that had more all-time highs was 1995, which had 77. Now, we're in second place, but it's a tie for second place with 1963. In 1963, we also had 65 all-time highs. We still have 5 more trading weeks to go, folks, in the calendar year. Do you not think we're gonna, slip this bad boy back, into third position, and we'll have a tiebreaker here? We'll have a full second place at least. We don't know. We may get up to 77. We may surpass that. There's plenty of time, and we're in the most favorable season of the year for S&P 500 returns. There's a reasonable probability that 2019 to 2023 could also produce 1995 to 1999 like market outcomes. We have 5 years in a row of double-digit returns in here. We've got 3 years in a row so far, 2019, 2020, more than likely, barring any significant consequential exogenous event, we're going to have double-digit gains here this year. As of Monday, the S&P 500 was up 25% for the year. It's going to take a lot, to get us down to 9% and kill off our, 2-year streak so far of double-digit returns. So we'll see. Again, this chart right here also highlights this was the only time we've had, going back to 1980, 5 consecutive years of double-digit returns. But the one thing I believe that investors might overlook here with this graphic of annual returns since 1980, it's probably because it's in small print. Despite average inter-year drops of 14.3%, that's the average decline since 1980. The average year declines 14.3%. Double-digit returns, 5 straight years. But right there in 1997, we had 11% correction. 1998, almost a 20% correction. And indeed, in 1999, a 12% correction. Still double-digit returns, but this kind of, level sets expectations going out to next year, because we haven't had a double-digit correction, a textbook garden variety 10% correction since the COVID crash. So we may still get double-digit returns next year, but we might also get some volatility and a full-blown garden variety correction. All right, this chart right here just goes to show you, this really examples the win streaks in the S&P 500 over the last month. This is a 1-month chart of the S&P 500, 1, 2, 3, 4, 5, 6, 7 days in a row. And then after brief relief, 1, 2, 3, 4, 5, 6, 7, 8 consecutive days in a row. Not just 8 consecutive days in a row, but each day had a new all-time high for the S&P 500. The S&P was up 18 of the past 20 days. The first time since 1971 that's happened. That isn't the crazy part. Apparently, 1971 had 2 separate 17 out of 19-day winning streaks. One early in the year and one late in the year. And again, as of Monday, the S&P 500 was up a little bit more than 25% for the year. In years that it finished up more than 25%, the following year was higher 12 out of 14 times. So we've had 14 years where the S&P 500 was up 20%, 25% or more. And 12 of those 14 years, the market was higher than next year. Think about 2019. 2019, the S&P 500 was up 29% or 31% on a total return basis, includes the dividend. And in 2020, we were up double digits. Right? We were up 18% in 2020. So just a more recent example of that. Gains beget gains. Strength begets more strength. Going back 30 years, there have been only 4 other times that saw the S&P 500 up greater than 25% year to date. So as of November, it's only happened 4 other times since 1991. Would you believe stocks were higher in December all 4 times? So if we were up 25% in November or by November, each December the market was higher. It happened in 1995, 1997, 2013, and 2019. So that data basically kind of helps to answer this question of whether or not we are going to break this tie here. Because we are up, or we have been up more than 25%, and each December has found a higher high. Here in November, we've talked about seasonality a lot. We came into the month, indeed, playing out perfectly. Strength in the beginning of November, then you kind of hit this choppy period here through the middle of the month until basically the final week, take off again. So keep this in mind as we are consolidating gains from the all-time high. This might be your second chance. This may be that opportunity to start re-leveraging. Nothing in our purview says that you shouldn't be buying this dip. All right. 8 and 8. Talked about the S&P 500 was up 8 days in a row. It's happened 14 other times since 2000. This is just an 8-day win streak. This has nothing to do with all-time highs within an 8-day win streak. So do keep this in mind because we have another study, more quantitative data that is going to consider an 8-day win streak and 8 days of all-time highs. But for this one, it's just 8 days in a row where the S&P 500 was up. Since 2000, it's happened 14 other times. That's this top chart up here. 14 different times, including the most recent. And what we can see from this study, only 4 of these occurrences saw the S&P 500 close higher the next day. So day 9, only 4 of the 14 occurrences did day 9 also finish higher, right? So it was a low probability that the market was going to be up 9 days in a row. And indeed, we were not up 9 days in a row. The probabilities played out. However, 13 of the 14 occurrences did see the S&P 500 close higher within 15 days. That's 93% of occurrences. Only 1 time did the S&P 500 not close higher within 15 trading days. So you're going to want to keep that in mind. And again, that helps us answer if we're going to, break the tie with 1960. Is it 63 or 65? 63, okay. 63 had 65 all-time highs. So quantitative data says strength begets strength. A pause is almost necessary to alleviate these overheated conditions. Find value investors coming back in the market, buy the dip. It's good stuff. All right, now this particular quantitative study, S&P 500 after all-time high streaks end. So the table above also this study only went back to 2000. This study will take us back to 1928 and looks at 8-day win streaks that also produced all-time closing highs in each 8 days. That has not happened very often, as you can see right here. Only 7 other times that has happened. So what are the forward returns after 8 consecutive days of all-time closing highs? Well, it shows how the S&P 500 performed after each of these 8-day win streaks. Let's see. So 1 week later, percent positive, not so great, right? Almost 50-50. Average return is good, but 50-50. The median return tells you there was a lot of negativity there. 1 month later, however, look at the percent positive. It jumps up to 71%. Returns, pretty darn good. So by the end of the month, early next month, and that also fits into the seasonal calendar where we get this liftoff at the end of November into December. 3 months later, so now we're out to January. Look at the returns, 5.28% and never been a negative return. Probably want to highlight this, folks. S&P 500 up 8 days in a row, 8 days in a row of new all-time highs. 3 months later, market has never been negative. And the average return is pretty darn good. It's more than 1% a month. You don't get that in your savings account. 6 months later, I'm sure there were corrections along the way, but 86% of the time, the market is positive. You get a 3.16% return. Strength begets strength. Market's giving you opportunities. Down 2 days in a row. So far, the quantitative data says these win streaks are positive. They're not accidents. Market just doesn't generally have accidents. It's human behavior and how market participants engage. All right. Now, last week, so within the context of these consecutive days, we were obviously up. We had a perfect week. Within these 8 days in a row, we had a perfect week, right? 5 trading days from Monday to Friday, the market was higher each calendar day. The last time that actually happened was February, earlier this year, which made number 20 since 1990. It's happened 20 times. So this was the 21st time, here in November, 21st time the market has been up Monday, Tuesday, Wednesday, Thursday, Friday in the same week. Here are the forward returns for a perfect week. 1 week later, kind of like the study we just looked at, a bit of 50-50. Returns are rather innocuous. 2 weeks later, we get a little bit better. Percent positivity gets better. 1 month later, indeed, much better. Returns are better. 3 months, yeah. 6 months later, percent positivity is even better. Returns are even better. 12 months later, indeed. And we're looking at double-digit returns there, folks. 1995 to 1999, 2019, possibly through 2022. Double-digit returns. We shall see. Sample size is really key here, folks. This has happened now 21 times. This was a smaller sample size. I often say, you need 7 or better. This hits it right at my threshold. It's my personal threshold. This may not, lend itself to everybody, but my threshold has always been 7 is the minimum. This one, obviously, 14 is the sample size. This has happened 14 other times. You want a good sample size. So when you see something like this gentleman put this tweet out there on June 8th. The last time the median S&P 500 short interest was this low was at the absolute peak of the dot-com bubble. It's a Goldman Sachs chart, 1.5% short interest as a market cap. And my comment to the person at that time was, it always seems rather short-sighted to compare a sample size of 1. Because that's as far as we're going back to find the likeness. Like, this is the standard. This is the parameter. Short interest being, 1.5% of market cap. It's only happened one other time. we really don't, that's not a sample size. Time is a constant. Time is not your sample, like the years that have been traveled. Time is a constant. It's not it's not part of the sample. The actual occurrences are the sample. So you can't do anything with this. It was my point in commenting. Seems rather short-sighted to compare a sample. Oh, I think I lost you there, folks. Sorry. Let's get back to business. So the connotation of this tweet is that when you have short interest this low, it's a bad thing, right? Doom and gloom, right? Nobody's short, so you're supposed to be contrarian. That means the market's about to tank because nobody thinks it will, so on and so on. The reality is we're comparing a sample size of 1. That doesn't work. And of course, what has happened, the market has only traveled to new all-time highs since June. Right? There's a lot of bad stuff out there on Twitter. Pay no attention to it. This is sample size once again. We can't forget what happened coming into November. We can't lose sight of what happened in past months simply because we've hit a period of overheated markets that exhaustively have found some consolidation. When the S&P 500 gains 5% or more in the month of October, it is undefeated 1 year out and overwhelmingly positive across most all time frames as offered in the study here by Steve Depp. We were up 5% or greater than 5% in the month of October. It's happened 11 other times, 12 times in total, including this year. 1 month later, market is higher 81% of the time. Pretty decent returns. 2 months later, the positivity rate is not as strong, but returns are pretty good, folks. 3 months later, again, takes us into January. 81% positivity. 4 months, 81%. 5 months, 81%. 6 months later, 90%. 12 months later, the market has never been red when we are up 5% or greater in the month of October. And again, look at the average return. Double digits. Double digits. It's a good sample size, folks. Goes all the way back to 1953 also. All the way back to 1953. What about the Nasdaq? All right, same thing. Nasdaq had a pretty darn good streak itself. It was up 11 days in a row, but let's look at streak of 8 straight all-time highs, which it also had. 8 days in a row of all-time highs. Nasdaq, after this streak, it's happened 11 times since 1971. Nasdaq tends to, really be a stronger index, if you will. 1 week later, not too good. And it's a toss-up. 1 month later, things are much better. 73% of the time, the market's positive. But 3 months later, down, and we're only positive 45% of the time. Again, you might want to circle that. 6 months later, much better. Market rebounds. We're up almost 4% on average. 73% positivity rate. So in general, the strength of the index, for the Nasdaq is going to find more frequent overheated conditions, and those overheated conditions tend to need resolution more often as well. But if we're going out 6 months, good things tend to happen. Something else with the Nasdaq that just happened, the Nasdaq McClellan Summation Index. Recall in the recent past, we've been studying the NYSE Summation Index. Through this early November rally, well, since October, but into November rally, where things have gotten overheated, the McClellan Summation Index for the Nasdaq has finally come back into positive territory. That's what this line shows here. We are now above 0. Nasdaq has had poor breath for much of the year. It's recognized by the McClellan Summation Index. After a furious rally to start the year, so many stocks were churning that breath on the Nasdaq couldn't surpass its highs at the start of the year. By midsummer, turned outright negative. That's this time frame here. And stayed there until last week. Going positive, This is the first time it's been positive in now 77 days. It's among the longest streaks since the end of the global financial crisis, in fact. Only 6 other periods saw Nasdaq's summation index stay in negative territory for longer than 77 days. Only 6 other times. After each of those streaks ended, though, the Nasdaq Composite gained an average of nearly 19% at some point within the next year. Good things happen. Good things happen when, we've essentially churned in the Nasdaq from basically February, and we've made new all-time highs, but not every stock within the Nasdaq has made new all-time highs. Underneath the surface, there have been a lot of negative price action, which is why the Nasdaq Advanced Decline Line has yet to make a new all-time high. All of the other indices have. The NYSE, the S&P 500, the common stock NYSE, they've all made new all-time highs on their advanced decline lines. Nasdaq's not even close. It really is. It's still not even close. Underneath the surface, breath has not been as good as you'd like it to be in the Nasdaq, but it's finally, seen the summation index momentum carry it over into positive territory, and good things tend to happen within the next year when that happens. It's no coincidence also that the Nasdaq 100 has stalled out at another round number. It hit 400 plus on Monday, and now it's checking back. And that's basically what this chart identifies. And if we look at the open interest for puts and calls, 400 has the most open interest. That's these final bars over here. Stalled out, had problems getting over 200. The Qs had problems getting over 200, finally did. Of course, this is COVID. Had problems getting over 300 right here. Churn, 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 and finally did. Nice check back. Continue to rally, and here we are, 400. It's checking back. It's consolidating. So, but this is market mechanics. Market mechanics. It's good that it's checking back here at 400, as it did at 300, as it did at 200. It tells you, really, this consolidation that's taking place after overheated conditions is normal and to be expected. All right, we've talked about the VIX in the past. Usually the VIX is down. It has a negative return in the month of November. Right now, the VIX is up. Given that we've had some consolidation here, the VIX is actually higher for the month of November as of November 11th. Still have a lot of time. We'll see what happens. But something that led us to believe that we were going to have a bout of volatility and consolidation. If we didn't look at anything underneath the hood of the S&P 500, if we didn't look at the RSIs, if we didn't look at breadth in general, we know that the S&P 500 and VIX, which are usually inversely correlated, positively correlated last week, and have stayed positively correlated into this week. Usually, when you have 2 weeks in a row of higher VIX and higher S&P 500, you tend to get continued volatility and a check back in the S&P 500. And that's what's shown here in these orange lines. These are 2-week periods where you have a positive correlation, S&P 500 and VIX. And usually you do see some degree of consolidation in the S&P 500 when that happens. Something else that told us, just to be aware, that even if the S&P 500 didn't consolidate right away, we were going to see more volatility. The VIX to bond market VIX, which is the MOVE index, so that's the bond market VIX. The VIX and the bond market VIX ratio was basically at the lows that it had previously seen going into the COVID crash. This basically just tells us that the bond market volatility eventually finds its way into the equity market volatility. So that's another way that we means for which we could expect some increase in volatility in the equity market based on this ratio here. All right, healthy reminder. Again, the market's giving you opportunities. It's up to you whether or not you're going to recognize them and take advantage of them. But as we talked about in September, when the market was correcting or pulling back 5%, indeed, the market will not send you an email or hold up a sign that says, it's time to buy the dip. This is up to you to decide. Our weekly research reports, our state of the market videos, they help to identify buy the dip opportunities, but not when to buy exactly. Again, that's up to you to decide. The best course of action using Finom Group's weekly research reports and state of the market videos, the best course of action is to identify your buy the dip signals as either flashing a warning sign, a true warning sign, or the remaining green. Green meaning buy the dip. If they remain green, simply layer positions as prices continue lower, as they should rebound given the green buy the dip signal. People tend to vote, what's your downside target on the S&P during a pullback? You don't need downside targets. What you need is cash on the sidelines and buy the dip signals that say buy the dip. Just allocate in tranches, layers. The S&P may not hit your downside target. I think that's what many people fail to re-leverage. They fail to buy the dip because they're so focused on downside targets. They're looking at charts for support levels, and yet this market doesn't give you that kind of precision before it resumes its uptrend. That's usually where people fail. They're waiting to hit a target. It's easier to focus on how to buy the dip as opposed to when to buy the dip. It's more about how, the practical means for executing that game plan. Now, even though this market has 65 new all-time highs this year, most Americans think it's unlikely that stocks will be higher a year from now, despite all the data we're looking at. And of course, most Americans don't have all this data. But they think it's unlikely that stocks will be higher a year from now. On average, people see just a 38% probability that U.S. stock prices will be higher 12 months from now. This is according to the New York Fed's October survey of consumer expectations. So at 38%, this is slightly below the historical average of roughly 40%. And basically, by this survey, the stock market is way up lately and valuations are above their long run averages, which I'm sure is playing into the sentiment of these respondents. What we know is that new highs beget new highs, right? 65 of them this year alone. The performance of the S&P 500 after all-time highs, 1 month later, higher, 3 months later, higher. All right, enough said. New highs beget new highs. And if you're worried about valuations, come on. There is no correlation between S&P 500 forward PE and the stock market's performance 1 year later. So as a measure of valuation, the PE multiple on the S&P 500 has absolutely no correlation with the S&P 500's performance going out 1 year. None. Don't let valuation be your determining factor as to how to allocate and when to allocate. It has no correlation going out 1 year with the S&P 500's performance. And while everybody is still clamoring for a correction, these are still the going concerns. Many that have been many there have been many theorized arguments as to why the S&P 500 should correct. Washington chaos, and we've got December ahead of us. where we've got to raise the debt ceiling again. Labor shortage, inflation, tapering, rich valuations, overdue for a pullback, weak seasonal patterns back in September. Mama said there should be a pullback. The reasoning behind cautious arguments all sound good in theory. These all sound reasonable, but only in theory. They're concerns that really just don't lend well to poor earnings. And all we've seen is while all of these concerns have manifested throughout the market and within investors, earnings continue to grow at a double-digit clip every single quarter here this year. And so far as tapering, what did we talk about sample size? What's our sample size for tapering? 1. That's it. That's what everybody was so concerned about. Sample size of 1. We'll leave it there, folks. Hope everybody has a great trading week. We'll see you next time.